So the next chart we're looking at is Apple. This is back in 2004, right at the beginning of its move. And you can see right here, highlighted by the green, is the cup with handle pattern. Again, we're looking at a depth of 24%, a handle only 11%, and a 19-week base. All the nice key elements are there. We have a volume spike on the prior uptrend. We have a strong prior uptrend. We have some more volume spikes on the right side. And what's really amazing about Apple, and you could really tell there was a lot of accumulation going on at the time, was look at all the tight areas highlighted by these yellow circles here. All these, here there's 4 weeks in a row where you close very tightly. Here we had 3 weeks, and in the handle we had another 4 weeks of tight trading. So there was really a lot of accumulation. And most of the great buys happened above the red 10-week moving average. So again, there's no real reason why you need to find these stocks that are beaten up or in downtrends. The majority of these strong uptrends happen in uptrends. So you can just wait for stock prices to get back through that 10-week line. To be honest, I rarely ever buy any stocks below the 10-week line or 50-day moving average, unless we're in a deep correction and I'm trying to test out, some buys to figure out who the next winners will be. But the majority of buying should be above the 10-week moving average, and you really remove that element, that risk that you're buying a stock that's out of favor or a stock that's being sold in a downtrend. We'll move on to the next chart. This is Fastly. So the Apple chart and the BKNG chart we looked at prior were stocks I didn't actually trade myself, but I actually did trade Fastly last year in 2020, and this is the monster pattern that I was able to catch. Now there's one unique twist to this. Although the majority of patterns, the cup and handle pattern, should have a maximum depth of 35%, there is a time where that can not be true, and that happens in market corrections. So the way I like to look at it, and I've heard William O'Neill also state the same thing, is that patterns should not correct more than about 2.5 times what the market corrected. So in this situation here, the S&P 500 fell 35% in a relatively short period of time. So although the cup base of Fastly is 59% deep, that's acceptable because the market was such a strong weight on the stock. And I mean, I was there watching it. Although this is 59% deep, there was kind of a couple of days here right at the bottom of the base where there was a washout due to widespread market panic. So in reality, it was somewhat more controlled to this. You can also notice here the handle depth of 18% was somewhat reasonable, and it was a 15-week pattern. So it took a lot of time. It built its base properly. And one of the beautiful things here is we can see we have this huge upside volume on the breakout week. We actually gapped out on earnings, and you'll also notice a lot of these breakouts will happen around earnings events because there's that new information that's being priced into the market. And this just caused a fantastic move higher, and it was a real rocket ship higher there. They're not always all this beautiful, but this was absolutely fantastic. So again, they all have that very similar cup with handle type pattern. It's best that you review the charts later on that you'll have in your chart book and really become accustomed to the pattern and how they work. It's just really important you have your checklist, you go through it, you check your depth, your length, you look for periods of tightness, you look for relative strength. Again, here you can see the relative strength. Look how quickly Fastly made it back to its prior highs compared to the S&P 500. Way sooner was Fastly back at its highs. So although it did fall with the market, the ability to rebound so quickly was investors piling back into the stock as soon as the storm clouds of the market had passed. Here we're looking at NVIDIA. I know we've already spoken about this a little bit with some other examples, but I want to dive in a little bit more here and look at this cup with handle pattern. Classic pattern, 27% deep. It was 1.9 times the market. The handle was extremely shallow at 6%, so that really means once we had the right side of this base, there was very little selling left in this stock. You'll see that there were strong volume spikes on the left side of the base. We had a strong volume spike off the bottom. We had our prior uptrend with strong relative strength. It kicked in as it became a new leader. And you'll really notice here that we had strong relative strength the whole way up in the stock. We covered this earlier. It was absolutely incredible how they would never sell the stock down with the market. Perfect cup with handle pattern. You can see here there were a couple of weeks of selling that did hit the stock. Like I said, that could be normal because there is some selling going on. But you want to see some good volume come back in on the right side, which is exactly what happened. Also on the handle week, we saw a reduction in volume showing that the selling was tapering off. It was more of a pause than a real dramatic sell-off. And volume reaccelerated to the upside once the stock price broke out. I also want to note here, I like to always look at, sometimes the stock will break out above prior highs or a cup with handle, but what I like to call is the expansion phase, where the stock really starts to lead and really advance quickly. And that's when you really want to see volume kick in. So although we did break above the cup and handle breakout here, and that was a legitimate buy area above the handle, this only really started to kick into high gear at this point here about a month later, and the volume really started to begin to surge. And that's really a key element that you need to see somewhere if the stock is going to be a really big leader with a big runway. Because if a stock breaks out of a base and just kind of lethargically climbs higher, doesn't mean it's a terrible stock, but to have a really enormous move higher like NVIDIA, where you went up 266% in 49 weeks, you really need to see that volume surge and that expansion phase where you can actually see institutions piling into the stock and chasing after each other to buy the stock. That's that critical acceleration point that is really evident with every stock as it embarks on its major up move. Another example here is Roku. So they're really changing the dynamic of how we watch television, and they're really taking the lead in the streaming business in terms of providing the ecosystem for people to stream their content. This was a fantastic cup with the handle bottom. We had a strong prior uptrend off of the COVID bottom, and you can see incredible volume spikes all throughout the base and basing process. We had tight weeks trading at the bottom right here. The breakout came with increased volume. Again, the actual buy point is above the high of the handle, so the pause point. And here we see the tight trading at the bottom of the base. Not all stocks have that component to it, such as Fastly, which was a little bit wilder, but it's always definitely a big plus when you do see that. And again, Roku, when this broke down with COVID, although a lot of other stocks presented great buying opportunities earlier on in the bull market that took place after COVID, Roku took a little more time to base. Fastly broke out, it was April, early May. Roku only started to break out in July. So when a bull market starts, there's going to be multiple opportunities, and some stocks just need a little bit more time to base. Either it takes investors more time to become aware of the story, or it just takes more time for the story to develop. But the bases are exactly the same, fantastic shape. It was only 28% deep. The handle was 16.8% deep, which is acceptable. And it was a length of 8 weeks, so it was just enough time for the consolidation to take place. This was a massive winner. It gave people plenty of time to buy the stock, even though a lot of merchandise took off right at the start of the bull market. It is a great example of how you had to buy even a few months after the bull market started. So you can really never take your eyes off the market. There are always opportunities. What's really critical and important is that you learn to find the right patterns that show you that institutions are accumulating the stock. Another key component here is, okay, there was a quick drop, jump off of the bottom, but you could have been buying the stock once the uptrend was proven. Once we got back above our 10-week moving average and our 40-week moving average, it was safer to buy. Of course, you give up some of this upside off the bottom, but you're looking for a low risk entry. Everything we do is really reward relative to risk. So once Roku got itself back above its averages, its trend was reestablished, the risk was diminished, and you were able to put on a good sized position, and basically you still had a 260% advance in only 33 weeks. That's an absolutely fantastic advance for the stock to have made. So we reviewed several cup with handle patterns, and it's really a slower shaping pattern. You have a small decline on the left side while it works its way back up the right side, and you have a handle, a last pause before you break out. It's a very common pattern, and it's a very profitable pattern, powerful. The next pattern we're going to jump into here is the double bottom. This pattern is a little more aggressive, I guess you can say, in that you're not looking for a stock that's only being accumulated, but you're looking for a point where the majority of investors are actually shaken out of their position during the second bottom of the double bottom. And it's a critical component because anybody who has sold a position or gone short thinking that a stock is going to break lower, once they're proven wrong and the stock starts to move up again, you have a number of people who are coming back into the stock. So everyone who sold the stock who thinks they were wrong has to buy their stock back. Anyone who went short has to cover because they're losing money. And anyone who isn't already buying is notified of this dramatic up move, and so you get additional new buyers. So you kind of get this critical mass of buying that hits the stock after this double bottom forms. So let's dive in and look at a few examples. The first example we're going to look at here is Netflix. Again, I tried to include a lot of stock charts that I actually traded myself. And this is one of the first really big winners that I ever caught as a growth investor. For years prior, I'd been doing a lot of different styles, and in 2010, I was able to really get everything to come together. And Netflix, obviously now we know today is the huge company that it is, but at the time, it really wasn't so certain that they were going to lead the world in streaming. In fact, most analysts were coming out downgrading the stock because they thought they wouldn't be able to keep up with competition, or they thought Comcast would offer a competing service. And it was just it's amazing, having actually traded and lived through this uptrend, the amount of negativity and pessimism around a stock that was growing so strongly and creating such a new market. I mean, what seems simple in hindsight actually was very unsure and tricky in real time. But you had all the key elements here. We had our prior uptrend, we had our double bottom base, which was 25% deep, only 1.5 times the market, because the S&P had created a 16.9% correction here in the middle of 2010. The length was 7 weeks, so just enough weeks that were required for a proper double bottom base. And so this is essentially what you're looking for. You're looking for a first low. We're looking for a rally back up that doesn't quite make to new highs. And then we're looking for a break lower that takes out the first low of the structure. So when I spoke about people selling their position or going short, as the stock breaks a prior low, most active investors are either selling or going short, and the expectation is that we are going to go lower. So when the week after you had this dramatic turn back higher, that really forces everyone to reassess their positioning. And the actual buy point occurs once the middle of the double bottom is exceeded, so on this week right here. And what was amazing was that how there was such a great volume spike that came into the stock. I remember seeing that in real time. I can still remember the buy point. It was $124.10. Some things just always stay with you. Although now we see it's a different price because of stock splits over the year. But again, you didn't have to buy the stock as it was falling. You could have waited for it to get back above its averages. In fact, even if you missed the double bottom buy, there were a number of pullbacks along the way, which we'll get into subsequent examples with. But this led to a 145% advance in 49 weeks. It was a very strong move, and it all kicked off with a beautiful double bottom base. Although it's not as common as a cup with handle base, as we'll see, there are many stocks that form double bottom bases, and it's a very powerful shaper pattern. Here again, we're looking at Roku. I also try to include a lot of different patterns with the same stocks, just so you can have an understanding that there are multiple ways to enter a winning stock. It's not as if, a stock that goes into a big uptrend only had one opportunity. There are many ways you can buy stocks at different points with low risk and having that high reward, without having to just buy and hold. So Roku here had a 26% double bottom base, less than 35% correction. It was 8 weeks in length, so it was longer than the 7-week minimum, and the buy point was above the middle bottom. What's really interesting here is we had this very strong uptrend on the left side. We had 11 weeks up in a row. That's extremely powerful. I mean, that is a clear sign that an institution is accumulating the stock, because every week for 11 weeks, the stock is moving higher and higher and higher, and that is not an individual investor. That is clearly institutional footprints. And once the stock had its normal pause and correction, you can see some volume did come in, but that is normal once you go up for 11 weeks in a row and you get into the vicinity of your prior high. There will be people who want to sell. But what's really interesting is after that first drop, you had 4 weeks that went almost exactly sideways. You can see that by closing almost in the same range for 4 weeks. You had one move lower to shape the second part of this double bottom, and the bottom of that low also had 2 weeks that closed basically in the same area. So despite there being a 26% correction, it was extremely controlled the entire time. And you can see here, once people were sold out of their position on this break, they were met almost immediately with a wave of buying. And you can see 3 weeks straight up, and then you had a breakout week on enormous volume. I actually bought this stock. There was a gap up on earnings. And it was really interesting because the market was starting to roll over at that period, just as Roku was starting to break out and run. Typically, stocks will run with the market, but there are situations where the market is correcting and the stock will start its major advance. And it all kicked off with this beautiful double bottom pattern. The next pattern I want to talk about is the shakeout plus 10%. So this pattern goes all the way back to the investing classic, the 1927 Reminiscences of a Stock Operator, where Jesse Livermore, whom the character was based on, discusses the shakeout plus 3 pattern. William O'Neill was an avid reader of and follower of Jesse Livermore, and he uses this pattern in his trading. I've called it the shakeout plus 10% because in reality, in the example he was using, he was looking at a $30 stock and he was looking at a $3 movement. So that's 10%. So I think 10% is a little bit of a better way to look at the pattern because not every stock is trading at $30. I kind of lumped this together with the double bottom base because the same dynamics are taking place. The shape may be slightly different, and the buy point may be different, but there's the same dynamics taking place with a shakeout on the right side of a base structure. So let's take a look at a few examples. I think it'll become pretty clear to you. What I do like about this, in addition to the double bottom, is it presents you another buy opportunity that is often ahead of where the double bottom buying opportunity would occur. So it allows you to get in earlier and actually can allow you to pyramid and add to a winning position when the actual double bottom buy point occurs a little later on. So here's a perfect look at Amgen all the way back in 1990. So throughout this course, I also used examples from different time periods so you can see that these patterns are not just specific to the current era. These patterns have been enforced for decades. I mean, if you look at William O'Neill's book, you'll see these cup and handle and double bottom patterns going back over 100 years. And the patterns are exactly the same. It's absolutely incredible. So if we go to the Amgen chart, what I find really interesting here is how throughout this 11.2% correction starting at point B, you'll see at point B, the market went much lower. However, between point B and point A, Amgen actually made a higher low. But the critical component we're looking at is at point A, we made a low for the stock. Shortly after, we broke that low, but it only fell 8.2% lower. So the way the shakeout plus 10% works is Jesse Livermore was looking at a stock that was $30. He said he always tried to find the line of least resistance. Basically, are there more buyers or more sellers, or are the buyers in control or are the sellers in control? And he said that if the low at $30 is broken, if a stock can't fall 10% or $3 and subsequently it turns around and climbs $3 above the $30 threshold, that the buyers are in control. Essentially, they broke the low, they couldn't get it to go much lower, and we completely turned direction and moved higher. And that's exactly what we see here. If we go back to the chart, we can see how the low at point A is broken, but only by 8.2%. And very quickly, we have a move higher by 10%, indicated by the second arrow on top. Now, if this was a double bottom, you would be looking to buy the stock above the highs of the bar at point A. But here you had a much earlier entry, 10% above the low of point A. So it just gives you that alternate buy point. It's along the same lines as the double bottom, but it's powerful to have that second opportunity to buy it much earlier. Overall, what's important is the length was 11 weeks. It was only 28.5% deep, 2.5 times the market. Again, the chart alone isn't what really drives these huge moves. Amgen was doing some incredible work in terms of how to help people with their blood problems. But these patterns keep showing up time and time again because it shows the demand and supply coming to a head in the marketplace between buyers and sellers, and how institutions accumulate stock, and that's why these patterns keep occurring over and over again. Another great example would be Shopify. So we discussed Shopify a little bit earlier about how their fundamentals led to this strong upside move of 37-fold in only a couple of years' time. But one of the great entries you could have had on the stock here, it was a shakeout plus 10%. So we see here in late 2018, the world was worried about Jay Powell raising interest rates with the Federal Reserve, and the market went into a somewhat significant correction of 20%. I guess it qualifies as a bear market. And Shopify corrected 30%, which was only 1.5 times the market, and it had a 13-week correction. But what was really impressive was look at how strong the relative strength was. You'll see here the market with this black arrow made much lower lows, and over that same period, Shopify essentially went sideways. Right at the end of that bear market, Shopify broke the lows at point A, but only fell 3.5% lower. It very quickly turned around and got 10% back above the low at point A and triggered the shakeout plus 10% rule. From that point on, it was almost a straight line higher. Everyone who wanted to sell did sell on the break of those lows. Anyone who was short had to cover their short, and all of the buyers who wanted to accumulate the stock piled in. In fact, I would argue that throughout this entire S&P 500 bear market, there were funds accumulating the stock, because when the market falls 20% and this stock can barely make new lows, that's someone taking advantage of a weak market to buy as much stock as they can. So that's why this is such a powerful pattern, because you begin with someone trying to accumulate a stock, and there's just a very quick break that sucks in some last short sellers or some last sellers, and it's quickly turned around the other way. And failed moves, as they say in the market, lead to fast moves. The last example I want to look at is also from that 2018 period. Oftentimes you'll see similar patterns at similar points in time because these patterns are affected by the market action. And The Trade Desk is another leader in the world of digital advertising, similar to Roku. And we can see here the market made much lower lows in 2018, and Trade Desk only barely broke the low at point A by 2.5%. When you got back above the low at point A by 10%, you had a beautiful buy point. It was a 36% depth, only 1 in 8 times the market. It was 13 weeks long, and this led to 150% advance in 33 weeks. So if you're aware of these patterns and you can find stocks with great growth stories sporting amazing fundamentals, there's not only one opportunity, there's multiple ways to buy them, and these patterns show up along multiple stocks. So if you're doing your homework and you're staying focused, these patterns do occur. And as you can see with the moves in Shopify, Trade Desk, Amgen, and Roku, there's substantial upside when you wait for the right amount of time, the right base sizes, and you buy it at just the right point. The next base we're going to look at is the flat base. So to be very honest, the bread and butter of my approach is really the cup with handle bases and the double bottom or shakeout plus 10% bases. The flat bases do occur, and they're a very great legitimate pattern. I just prefer the other bases. I've seen stronger moves develop from them. They're a little bit deeper, a little bit longer, and there's a little more depth to them in terms of what's going on within the base. However, the flat base is still a great pattern to be aware of. And there's really two major errors you can make when investing. You can either lose too much money when you're wrong, or you can miss out on a major advancer. So although the flat base is probably not my favorite pattern to use because I find the moves are not as explosive coming out of a flat base, there are sometimes some rather dramatic moves. So it's definitely not a pattern that we can ignore. As I mentioned earlier, the length of the base needs to be at least 5 weeks. But here we're looking at a shallower base. We want it to be maximum 15%. And this is never usually a first base in a move. This is typically something that occurs a little bit later in a stock's advance, and it's more of a pause along a longer, more dramatic trend. I guess for that reason, it's not as a dramatic move as well because it's not starting from the very beginning. So let's take a look at Coupa Software back in 2018. As you can see here, we had a strong uptrend. We came out of an earlier basing structure, essentially a very large cup with handle as a general structure. We had a very strong move higher, and the market went into somewhat of a correction. And as you can see, points A and B were at the same level, but here the Coupa Software made a much higher low between point A and point B. And essentially this weak market condition just forced it to take a pause on its advance to its highs. And it was 7 weeks long, it was a maximum depth of 13% and 1.5 times the market correction. As you can see here, you still had a 65% advance in 18 weeks out of the base, so it's not a base you want to ignore. But just as I mentioned earlier, it's usually something that happens midway or along the actual move. What I like about the other bases compared to a flat base is that there are usually more buying areas available because they're usually a little bit deeper. At a 13% depth in this base, it's a little more difficult to pyramid into a position because there isn't as much movement. But yet again, it still led to a 65% advance in 18 weeks, so it's definitely something we want to be aware of. I decided here to look at Coupa again, just to show you how these same patterns kind of show up. This high here in August is the high of the prior chart. We had a correction with the market. We had a strong move higher. And you can see here we formed another nice 5-week base, flat base, before it advanced another 48% in 13 weeks. The depth was 14%. You had a very strong prior uptrend. And look at the amount of tightness or very controlled ranges within the basing structure. So despite a very strong advance, we had a down week where obviously it had to correct somewhat of the advance that it made. And then we basically went sideways as buyers and sellers were kind of trying to determine where the next course of events would be. As it went sideways, eventually buyers got the upper hand, we broke higher, and we had our 48% advance. So it's a rather simple pattern. It does not provide as many opportunities to enter the stock as other patterns do, but it's definitely something we need to be aware of. The next pattern I want to talk about is the rarest of all patterns, but it's also the most explosive. It's often misunderstood and misused, but it's definitely something you want to be aware of. The pattern is the high tight flag. So it really happens under certain situations, and you pretty much need a hot market for this to take place, but 2020 was a perfect example. If we take a look at this chart here, this is MicroStrategy. And essentially, a high tide flag similar to the flat base occurs midway in a move. It's never how a stock will start its advance. Here you can see MicroStrategy actually came out of a very large cup with handle pattern, and we bolted 125% higher in only 5 weeks. We then corrected 3 weeks sideways, only 23.6% deep, and then we exploded to the upside. We had a 275% advance in only 7 weeks. So really that first move up that was really strong, 125% in 5 weeks, that shows that there's some immediate demand for the stock. There's some kind of game-changing situation going on, and there's people surging into the stock to buy it. Now, the fact that you only go sideways for 3 weeks and correct 23% after such a staggering advance shows you that the buyers are still around. There's somewhat of a supply issue that they came into. There are some people who are taking profits, but buyers haven't dissipated by any means. And as soon as we break higher on good volume, we know we're in for one heck of a ride higher. And what I wanted to do here was I wanted to contrast this with MicroStrategy itself. Amazingly, 20 years earlier in the dot-com bubble, MicroStrategy built a very similar high tide flag. If we take a look here, just as it did in 2020, in 1999, MicroStrategy came out of a beautiful cup with handle, and we bolted higher 140% in only 7 weeks. We went sideways for only 3 weeks, just like the 2020 pattern, with a depth of 21%. And then amazingly, we went up 559% in only 16 weeks. So it's an incredibly strong pattern, but it is very rare. What I find really amazing is the fact that MicroStrategy had the same pattern with almost similar dimensions 20 years apart. But it's a pattern definitely to be aware of. Again, because it's so rare, it doesn't show up often, and not every single rally in a stock that goes sideways will qualify. You want to see at least an 80 to 100% advance within 8 weeks, and you want only 5 weeks sideways at a maximum with only a maximum depth of 25%. And that really puts it in certain criteria parameters, so you know you're dealing with a high tide flag specifically rather than any rally and then a pause. And that really sets up the move for a potential major advance. So it is very rare, something to be aware of, because when it does occur, it usually delivers outsized gains. The last shaper pattern I want to discuss is actually the only shaper pattern we'll be talking about that William O'Neill hasn't mentioned in his investing classic. And this here is a long triangle or a coil. This was really originally taught to me by Edwards and McGee in their classic, the 1948 classic, Stock Market Trends. And basically, you're looking for a pattern where the volatility is continuing to diminish throughout the pattern. You have a series of lower highs, and usually you have a series of higher lows, and really volatility is diminishing and demand and supply is coming to an equilibrium. Through my studies, I've noticed, again, very similar to the cup with handle and double bottom, you want a maximum depth of 35% and a minimum length of 7 weeks. But sometimes stocks just don't fit comfortably into a cup with handle or a double bottom pattern. And it's really just a matter of volatility diminishing, but it sets up some great entry points. What I really want to focus on, you'll see in the examples here, is how to properly define them with trend lines and with these various parameters. And it'll start to become clear to you that these patterns do occur rather frequently, and they do set up some great buying opportunities. The first example I want to look at here is Goose, Canada Goose Holdings in 2018. So we had a tremendous uptrend that started out of really what was a cup with handle pattern here earlier on. And we went into a 10-week consolidation. Now, at first glance, this is not really a cup with handle pattern because the left side of the base is only 1 week, and most cup with handle patterns are rather symmetrical. Here you can see that it's not really double bottom because no low broke a prior low, and it's way too deep to be a flat base. But what's really important here is how you can see the volatility really diminished throughout the base. And one of the key defining points is you want to have a 3-touch trend line on the upside of the pattern. Now, 3 touches is really crucial because if you only have two touch points, anything can really qualify as a trend line. So the fact that there are 3 touch points, that third touch point really proves and confirms the fact that there's a line of resistance on the upside of this pattern. And so once we break through that upward line of resistance, usually we also take out the high of the last touch of the trend line. That starts the breakout of the pattern. And as you can see here, we had a 93% in only 10 weeks. If we were looking for any of the other patterns, they wouldn't have occurred, yet this coil triangle pattern perfectly called the setup in this Canada Goose stock. You have as well very strong relative strength throughout the pattern. As you can see, you made a series of higher lows, whereas the market made equivalent lows. So you had all the other general criteria that exists in the shaper patterns. It's by no means only relevant to Canada Goose. You can see here in Teladoc that you also had a very similar pattern. So perhaps you can see that there was a cup with handle here that formed near the end of this pattern, but really this entire consolidation took place for quite a long time, 36 weeks to be exact, and you had really 3 touch points providing overhead resistance throughout the entire pattern as the volatility diminished. You can see each wave down is less than the prior, and you really have a point where the market is getting to a point of equilibrium. We break out here on rather substantial volume, and we start our move higher. A quick retest of that same line really confirms the fact that was a line of resistance. And we had a secondary breakout and a real expansion phase that took place just before COVID actually hit. And it's amazing that Teladoc, being a telemedicine service, actually was in a well-defined uptrend, broken out ahead of this amazing catalyst for the stock, which was a bad situation of a health crisis. But it's amazing that all of those conditions were in place prior to the actual COVID bull market taking place. And it was really well highlighted by the fact that we had this 36-week coil triangle pattern. Tesla is another great example. We can't really define this as any other pattern as a cup and handle or a double bottom. We have a higher low here. And this is really the best way you'd want to see this pattern form. You had volatility diminish along the pattern. You had 3 clear touch points on the upside. And you had this strong relative strength throughout the pattern as well. Again, the market made a lower low at point B versus point A, and this stock made a higher low at point B versus point A. So the relative strength was really calling out to you. And 2 other key points is you can see how the volume really diminished as the pattern went on. So you really were getting to an equilibrium. And then as we break through the upper line, volume expands, and you begin really your expansion phase where Tesla made its dramatic end move here of its trend into the highs of early 2021. It was also, you had a prior uptrend which really had Tesla moving higher before this pattern took place. And so all the elements of a shaper pattern were well evidenced here by looking at this coil triangle pattern.